let's just kind of get into it. If you attended the last webinar on the Gray Fund, we touched on some of these topics. I wanted to really kind of distill down some of the kind of issues we're seeing in the market, how we're mitigating some of those issues and risks, and really setting ourselves up for success. Because at Gray Capital, we've taken a little bit of I would say greatly different posture. As the markets have significantly changed over the last several weeks and really month. We're just in a completely different environment than we were a few months ago. Demand for multifamily apartments is still at an all-time high. We saw year-over-year rent growth coming in last month, breaking records at 15% year-over-year nationally. Occupancies are at an all-time high. So that's all great news for multifamily, not to mention the incredible supply and demand imbalance that is still in the market. However, we got a lot of other things are going on, not to mention, a war in Ukraine and interest rates rising significantly, especially that 10-year treasury that I was hitting up at 2.7%, I believe, yesterday on Friday. So these are factors that we really need to closely pay attention to. And the strategies that made a lot of sense and were the appropriate strategies last year, I don't think are the right way to look at acquiring multifamily apartments, especially in the way that you're going to finance those assets. You have to be much more careful than you were 6 months ago. And at Gray Capital, we're very much in tuned to the changes in the markets. We're staying up on top of the market every single day. You can subscribe to the Gray Capital YouTube channel to see our weekly Gray Report episodes. We're breaking down all the new market trends, research reports. So if you want to go over to YouTube and search Gray Capital, we will pop right up. Make sure you subscribe to that as well. All right, let's just get started and get into it. First, like I was just mentioning, I want to mention some of the risks revolving interest rates in 2022, and then I want to get into the first project that we have under contract for the Gray Fund. And then again, anytime you'd like to ask a question, you can just pop that right into the chat feature, and I'll get to it as soon as possible. Again, you can go to gray.fund to learn more. You can go to graycapitalllc.com. We have our investor portal. If you want to just sign up for the Gray Fund right away, you don't technically have to talk to anybody. You can just go on, create a profile, and invest today if you would like. The Gray Fund does feature a dual class structure that allows investors to combine two different classes of equity to create a tailored risk and return profile. Really, it allows you to really create an investment that is tailored to your needs and goals, that is backed by solid, stable, cash flowing multifamily assets and a diversified portfolio of 7 to 10 properties. But again, let's look at these risks. There's a lot of uncertainty in the market. I think if right now, if we could call this time, we could label this time period to be, uncertain. Not only do we have a war in Europe, we've got politics, coronavirus that keeps popping up and down. Interest rates moving, we're just in new economic times in general, and very few people know where it's going. And I think that requires us to take kind of the proper steps and precautions to tailor the most appropriate investment that will give us an appropriate balance between risk and return. Because I believe that there is the risk profile today is not the same as it was. We're looking at some nonlinear and exponential risk if you structure a deal in a certain way, and if you're exposed to interest rate volatility right now. We don't know where interest rates are going to go. If we look at the Fed dot plot, what they've been communicating, they're saying that the Fed funds rate, and which is SOFR, the secured overnight financing rates, a lot of variable rate multifamily loans are based on. It could go all the way up as high as 3%, anywhere between 1.7 and 3%, which would significantly change a return profile if you had no interest rate hedge and you hadn't mitigated that risk. And a lot of apartment operators over the last couple of years have been comfortable in a low and lowering interest rate environment, but the winds have changed direction. I think uncertainty creates opportunity, however, because with this uncertainty, like I said, apartments are still seeing record demand. Inflation will still be a driver of rents, and the way that owning a home is incredibly much more unaffordable than it ever was today is just creating a larger pool of renters. And I think targeting, really kind of these B class kind of median demographic investment strategies makes a lot of sense in today's market. And that's what we've been pursuing at the Gray Fund. So we can just say it's a risky market and not do anything, but I think it's more appropriate to really just quantify the risks, mitigate and adapt to the current market to take advantage of the solid fundamentals in multifamily housing. But let's look at the Fed tightening in this interest rate shock that has markets and real estate investors, worried. Berkadia did a really interesting study. It was several months ago. I interviewed Noah Stone, one of the authors on the piece on the Gray Report, a little over a month and a half ago, kind of really digging into looking at the past in similar events. And I would say no past events are really the same of what we're dealing with today, but it gives us a little bit of information of how multifamily apartments performed in, I would say, somewhat similar environments. But then after that, I want to look at what are the actual steps that we can take and Gray Capital is taking in order to mitigate these risks. So the conclusions of Berkadia is really that, major changes in monetary policy take about 5 to 6 quarters to affect leveraged apartment returns. Now, again, the timeframes post-COVID have certainly been compressed, but real estate in general is quite a bit of a lagging indicator. And we don't believe that we're going to have, an immediate shock to a multifamily. Now, that being said, we are seeing some softening in the market, but really kind of a healthy transition from instead of seeing apartments trade significantly above their kind of asking price, which was kind of historically not normal. We're seeing properties still trading for what they're asking for, but not necessarily, again, 5-10% over what they had been trading for. I mean, a lot of this has to do with just rising interest rates and not being able to get the financing and the high leverage that many apartment operators are looking for. Another conclusion that Berkadia made that in eras of kind of stagflation and quasi-stagflation, apartment returns actually outperformed most other asset classes. Now, stagflation is essentially when we have kind of lower GDP growth, but we have some kind of low GDP growth and high inflation, or high unemployment and high inflation. Now, we don't have high unemployment. In fact, we have record low unemployment right now, especially in the markets that we're targeting, like Indianapolis. I think December we were at 1.2% unemployment. But the concern is that if growth all of a sudden really slows down, which I don't necessarily think it's going to, but if growth immediately slows down and we still have high inflation, that creates a little bit of a perilous situation. But looking back at the past and quite a few quasi-stagflation scenarios and periods of time, apartments still performed really well compared to other asset classes. And even in a rising interest rates environment, and even in taper tantrums where the Federal Reserve is unwinding its balance sheet, apartment returns still kept up and again outperformed. So again, this is from Berkadia. Looking at apartment returns in an inflationary environment, apartments again track inflation, especially if you have a large portfolio like the Gray Fund. We're tracking inflation on a daily basis because we're signing new leases on a daily basis. As prices go up, we can reset our prices at a very, very high frequency, and even a higher frequency than most other commercial real estate asset classes. Then also looking at kind of the 10-year treasury and the correlation to returns in apartments, because a lot of people look at, the 10-year treasury because so many loans, especially fixed rate financing, and just it's one of the key indicators for the kind of the cost of capital, your financing rates. How does that relate to apartment returns? Many people would look at the difference between the 10-year treasury and current cap rates, looking at what that spread is. But when we actually take a closer look, there's not as much of a correlation directly between the 10-year treasury and apartment returns. Again, it's this lower right graph, and it's a little bit all over the place. There's not a direct correlation. Where you could get in trouble is if you're buying at a cap rate that is just way too low, and we've seen cap rates just plummet. I mean, sub 4, even like in high 2s, incredibly low cap rates. if you're buying at a high interest rate, you're going to have very little cash flow that first year. So again, there's a different risk profile currently in the market related to financing driven by, monetary policy unrelated to housing demand. And so how do we take advantage of the incredible demand for apartments while not getting tripped up by, monetary policy and interest rates? Again, this is looking at apartment returns during the last time the Fed tapered their balance sheet, which they are getting ready to do. There was not much difference in returns during that period, although we certainly want to watch as the Fed attempts to unload quite a bit of their balance sheet and holdings of mortgage-backed securities. I think they're going to be relatively slow to do that, at least on the MBS side. Probably not selling, more just letting those bonds burn off. And then looking at how apartments performed compared to other asset classes in, again, these quasi-stagflation environments. Apartments really outperformed, especially even looking at the stock market, looking at the Wilshire 5000 and the NASDAQ, that was actually negative. Apartments outperformed those other two asset classes. So what can we do? Because again, there's an incredible opportunity with the demand for multifamily apartments. But how do we not get tripped up by these rising interest rates? So we're doing a couple things here at Great Capital. We're looking more at fixed rate debt rather than floating rate loans or bridge loans. If we would use a floating rate loan, we are buying a cap or using some kind of hedging instrument to limit the amount of interest that we could pay. But we're also, I think it's important to watch organic growth. Now that's just basically make sure that we're not over speculating, because I think one big pitfall that many investors could be making right now is over speculating the length that we will see incredible rent growth. Again, we're still seeing a lot of strong rent growth, but some lofty projections in multiple years down the road could really affect the overall return. And it's important not to over speculate. Looking at what's happening, what has happened, there is a big difference between market rates and effective rates right now, rental rates, and most of that will be absorbed over time. But after that, we don't, predicting rent growth in 3 years is very challenging, and it's really not something that you want to be building a business plan around. You want to look at what's happened and what's happening right now.